Hello, welcome everyone. So we are going to get going with the remaining portion of the topics. So what we are going to do is we are going to talk about the inflation from where we stopped yesterday, and then we are going to talk about one of the key topics in CFA Level 1 is where we are going to talk about monetary policy of central bank and fiscal policy of the government, how they work together in achieving the macroeconomic objectives of a country. So that's going to be a very big topic for today. We got a large agenda because that's one of the areas which you need to understand for you to understand the overall what's going on in world economies in your own country, why central bank is reducing interest rates or why they are increasing interest rates or why the government is coming up with a deficit budget as part of their fiscal policies. So what's going on in the global economy to understand and decide what would be the consequences of that. It is very important that you understand this fiscal policy and monetary policies very well. Besides that, this particular topic can very well be incorporated into a couple of questions in CFA Level 1 in your forthcoming exam. So that way, today's study session is going to be a very important one. So let's get going with where we stopped. I think we stopped at inflation, the calculating rate of inflation. We said one of the primary method of calculating inflation is using consumer price index, where we are going to calculate the inflation as the movement between the price levels of a basket of items and how they have moved from a base period to the current period based on a specific weightage for those respective items in your index. So that's what we said, how the inflation is calculated in the real world. And there are also other methods of calculating inflation. We are going to discuss them about that briefly. One is price index for personal consumption expenditure. So the difference between CPI index, CPI stands for Consumer Price Index, and this index, now the weights on the products and services in the index. So when you say the weight, we are actually talking about different products and services. What is the weighting in your overall index? I mean, weighting reflects the consumer spending, meaning that if you are spending 40% of your money on food, then the weightage should be 40% there. If you're spending 10% of your money on gasoline, that has to be reflected in your quantity. So, end of the day, the weighting for CPI is based on consumer expenditure pattern. If you take an individual, how much money you are spending on food, how much money you are spending on shelter, and things like that. That is what we use that as a weighting scale. And any movement on those prices based on the respective weighting is going to help you to calculate your rate of inflation. So that's what we do. So there is something called price index for personal consumption expenditure. The difference between this and CPI is that here we are going to assign the weightings based on surveys of businesses instead of surveys of consumers. Now, here typically what we do, we calculate these weightings based on the surveys with the consumers to understand how much money people spend on different product and services. But here it looks like it is done based on businesses. The surveys will be done by businesses. The businesses are going to tell how much money people are spending on various products and services. So that's what it is done. GDP deflator, you know what it is. This is a GDP deflator is used to convert nominal GDP into real GDP. Hope you remember that, how you convert nominal GDP into real GDP. If you divide, your nominal GDP by your GDP deflator, you are going to get the real GDP. right? So GDP deflator can actually be used to calculate the rate of inflation in a country. We saw that in when we discussed about GDP deflator. Then you can use the producer price index. So what we were talking about is the consumer price index. So this is producer price index. So this is going to reflect the movement in prices of raw materials and intermediate goods, not the final goods. So there, what we are going to do is we are going to look at the price movements of crude materials, intermediate goods and finished good prices. It's like producer price index. When you talk about the different goods and services, you will also see, in addition to finished goods, you will also see most of the intermediate goods and raw materials coming into the picture. So different type of measures are used to measure the rate of inflation, but one of the common methods used to measure inflation is CPI, Consumer Price Index. Now, this is a very important topic. You should know this for CFA Level 1 exam. There is a difference between headline inflation and core inflation. So what is headline inflation? When you say headline inflation, the price index that you are using to calculate inflation includes all goods and services which people consume as part of their living. However, when you talk about core inflation, you are excluding food prices and energy prices from there. So you're going to remove food and energy from the weightings, give them a zero weighting in your index, meaning you are removing them. So you're calculating core inflation excluding food and energy. So headline inflation includes the price movement of all the goods and services, but core inflation excludes food and energy. So you should also understand why the core inflation excludes them, because you should understand that energy prices are very volatile, oil prices are very volatile in line with what's going on in the global markets for crude oil. Your oil prices are volatile. Food prices are volatile due to seasonal factors and due to various supply side shortages, etc. So food and energy are considered to be kind of very volatile. So they are going to really make your inflation numbers distorted. So when you calculate core inflation, you remove food and energy from that. So now we are actually going to talk about limitation of inflation measures. What are the problems that is going to happen when we are using CPI index in calculating the inflation in a country? We normally believe that CPI index is going to overstate the true rate of inflation. What does that mean? If your inflation is 10%, your CPI index is going to overstate them about 10%, and we're going to talk about why. You need to understand that CPI index overstate the true rate of inflation. There are certain reasons for that. What are the biases? There are biases, upward bias and downward bias that is out there. So price increases due to quality improvements are being masked. If you really look at it, price is changing from $100 to $120. Maybe the quality improved. The company added more features into it, so that's why they're increasing the prices. For example, if Apple comes up with a version of the product and they came up with iPhone 12, the prices were higher than the previous version of it, so which would mean that the price is increasing, but obviously the quality increasing. But from a CPI index perspective, this is just going to treat that as an inflation. It is not going to give any consideration for the quality. So that is one. And then they look at the other one. New goods replace older, lower priced products. What does that mean? Now, what happens in terms of your consumption, whatever you are doing? I'm talking about the weighting scheme. Sometimes you give up on certain goods and then you buy new goods. Maybe those new goods are expensive ones. So what's going to happen is that If you are buying more and more advanced products now, they are obviously more expensive. I mean, think about it. 10 years ago, probably you were not using, a smartphone, or even 5 years ago, maybe you were not using a smartphone because you could not afford. So the weightage of that smartphones in your weighting scheme is going to be lower. But now, since you start working, you want to buy the best phone in the market. So the weighting of expensive products play a dominant role, thereby creating an upward bias in your CPI index, because most weights are going to be given to expensive products, so that your CPI index is going to get overstated. There is one more bias coming from consumer substitution of lower priced products for higher priced products. So you're going to actually substitute lower priced items, you are going to substitute them with higher priced items, meaning that if something is very expensive, you are going to find a cheaper substitute for that. This is going to have a downward shape, downward bias on your inflation number, because you are finding cheaper alternatives. So your weightings for cheaper products increases. That's going to have a downward bias. These two have upward bias on your inflation numbers. This will have a downward impact. End of the day, generally you say that the calculated inflation rates overstate the true inflation rate in the country, simply because the upward biases are significantly higher than the downward bias. Moving further down, there are two types of CPI indices that you need to be familiar with. This gets tested in the exam. You should be able to compare, pay attention to the learning outcome statement. You should be able to compare last year's index with past index. Right? So what we are going to do is, in last year's index, now when you are calculating inflation, you are actually going to use the base period weightings in your inflation calculation, and you're going to ignore the latest weighting of your products and services. If you understand this CPI index, what's happening here, you got quantity, this is the consumption of people on various products and services on your base period, and these are the quantities on your latest period. And this is your price at base period, and this is your price at current period. So we know that we are going to compare the difference between current period and the base period in terms of pricing. But what are you going to consider for your quantity, which is the weighting scheme? So here in PASE, what you're going to do is, you're going to use the weightings as of the latest period, current period weighting. So what we're going to do is, we're going to take 205, not 200. Multiply that by 250 first, and then multiply that by 3. So we are using the latest weighting for us. And when it comes to last year's, what we do is, we do base period quantity, which means how much weighting that we are going to use for cheeseburger. Can you tell me how much weighting that you're going to use it for cheeseburgers? If you're using last year's, where you're going to use the weighting of the base period, what are you going to use? Are you going to use 205 units, or are you going to use 200 units, guys? You're going to use 205. You're going to use 205, because I'm talking about not last year's, I'm talking about this one, the second one, per se. So what do you use here? You use the current period weighting here, and what you use for last year's index, you are exactly right. For last year's index, we actually use the base period quantity. So we use 200 for last year's, but for this one, we actually use 205. So you see what's happening, 205 everywhere. And movie tickets, 45. So if it is last year's, what do you use for digital watches? And trying to test your understanding. What are you going to use for digital watches if you are going to use last year's? If you are going to use last year's method of calculating CPI index, what are you going to use for digital watches? Are you going to use 100 or are you going to use 105? Which one are you going to use? If you are using last year's, so last year's means how many units are you going to use as you're waiting for digital watches? Is it going to be 100 or 105? Okay, there's nothing complicated here. Last year's is based on base period prices, sorry, base period quantity, and passe is going to be based on latest quantity. So when you're talking about digital watches, what is the number of units that you're going to use if you are using last year's as your CPI index? Can you answer this question? If you're using last year's, what are you going to use? Are you going to use 200 or are you going to use, sorry, 100 or 105? That's the question. I'm talking about digital watches. I'm talking about last year. So in your weighting scheme, what are you going to use? You're going to use 100. Guys, remember, I'm talking about last year's. There are two types of methods to calculate inflation. Let me repeat myself. One is last year's, the other one is past. So if you want to show it, look at this. CPI is calculated using basket weights from the base period, that's last year's. If you remember, we already calculated an inflation based on 200 units. We are going to use both sides, reference period, both period, we are going to use 200 units, and but the prices are going to be base period prices for the reference period, and we are going to use the current prices for the current period. So that's last year's. But if you want to use the other one, per se, what you do is you're going to take the current period on both sides. Got to remember, this is something that can get tested. So let's summarize. For last year's, what is the weighting scheme that you're going to use? Are you going to use the current one or the base one? For the last year's, you're going to use the base one. For the past year, you're actually going to use the current one. And then what you do, you identify 2895 is your current prices, current value, old value is 2530. And you calculate the inflation, 114.43 is your inflation. So basically your inflation rate is about 14%, but if you really look at the last years, it is 16%. What do you think is the reason? I mean, if you look at the reasons for the differences, the prices have not changed, it's the same in between two questions. So how do you explain the difference between the rate of inflation there is 16% and the rate of inflation here is about 14.5%? How do you explain this? Why such differences exist? Can you tell me the difference between these two is relating to the quantity, relating to the weighting that is used? In last years, you used the base period weighting for both. Here you use the actual latest period weighting for both. So that's what it means. You're actually going to talk about maybe your inflation, is lower now in passe means you are more consuming cheaper products. There's a substitution effect coming in, if you agree with me. So what's happening is here you are consuming more of cheaper products. So you see the effects of using expensive products less, and you are using more of cheaper products. So that is what actually driving your lower inflation here. So that's something that you need to understand. Right, now we are actually going to talk about different type of inflation, why there are inflation in an economy, what factors contribute to inflation. Inflation is where the prices of goods and services increase on a consistent basis. That's what inflation is. Why do you think inflation happens? Think about demand and supply. By only looking at demand and supply, what would you say? Why do you think your inflation increases? The inflation increases for why? I mean, think about demand and think about supply. So how are you going to explain your inflation here? Inflation, when do you think there will be higher inflation? When you have more demand or when you have less demand? When do you have more demand in an inflation scenario? When do you think you're going to have more demand? When do you think you're going to have more prices? Exactly, there you go. That's exactly the answer. More demand. The demand is more, but supply is limited. That is where the inflation. So inflation can come to you through supply side. It can come to you through demand side. So cost push inflation is normally we say wage push inflation is because input prices increasing or wages increasing. Due to that, reduces cost of inputs increase. So they reduce the supply. When they reduce the supply, what happens? There is going to be a disturbance in the short run aggregate supply that is going to increase your price level. That is number one. There is something called demand pull inflation. That inflation is caused by increase in aggregate demand. So your aggregate demand is increasing maybe because people have more money to spend, or maybe the government is giving you more subsidies, unemployment benefits. You have more money now, you are creating more demand. When you create more demand, if the supply doesn't change, the prices are going to go up. This is again something that you need to understand. So you need to understand there are two types of inflation. One is caused by the supply factors, where input prices go up, supply get disrupted, prices go up, inflation. The second one, demand pull, there is an increase in the demand due to higher wealth of people, higher spending capacity, whatever it is, the demand goes up, and when the demand goes up, prices go up. That is demand pull inflation. So we are going to actually show that in graphically what happens cost push inflation in the short run and we get supply. What's going to happen? Now I'm going to ask you questions and please actively participate if you want to understand this better. You know why do you think your AD is downward sloping when you have price level on one axis, you have GDP on the other axis? Why do you think your AD is downward sloping? Because at higher prices, less demand, at lower prices, more demand. Downward sloping AD. Why do you think your short run aggregate supply is upward sloping? Because in the short run, you can adjust the supply even above full employment. So which means your short run supply curve can go above your full employment GDP for a short period of time. Why do you think your LRAS, long run aggregate supply, is perfectly inelastic? Why do you think it is perfectly inelastic for prices? Prices go up and come down. It cannot change because all the staff, all the resources are fully employed. That's exactly right. That's a full employment GDP. Okay, now I have a different question to you. How would you increase the full employment GDP? Can you increase the full employment GDP, or can you increase long run aggregate supply, or how do you bring economic growth? How do you do it? If you want to increase that, it's a full employment GDP. But if you want to shift that to the right, what can you do about it? You improve your productivity. That is one way to do it. Is there anything else that you can do to increase it? You can increase the labor, increase the discovered natural resources, increase the capital. So how you increase the labor is relaxing your immigration laws. So when you do that, you either increase the amount of resources that you have, or you increase the productivity through technological innovation. That is how we achieve economic growth. Although there is a different learning outcome, given its importance, I decided to talk again at this point in time. Now come back to cost push inflation. We are now going to talk about cost push inflation. So now, when the cost of raw materials go up, you should tell me now, what will happen to your short run aggregate supply? Is it going to reduce or is it going to increase? When your input cost is increasing, cost of inputs is increasing, it is going to reduce. So when your short-run aggregate supply curve is going to shift to the left, then what do you think is going to happen to the prices? What would happen to the prices in that case? When supply curve shifts to the right, the left, you see what happens? See what happens? Your prices are going to go up. However, now you are below the GDP, below the full employment GDP. So what do you think now? Your unemployment rate is more. So there is a downward pressure on wages. When there is a downward pressure on wages, your supply will increase more because now the cost is lower. Companies try to hire more people and starting to increase production. So you will again get back to your full employment GDP, but the problem is your prices are going to be much higher now because of the restriction on your supply. If the government doesn't intervene, this is what will happen, and that is what caused push inflation. So now I'm going to talk about demand pull inflation, slide 125. So now you need to tell me if there is an increase in demand, maybe because your money supply is increasing, people have more money to spend, people's income is increasing, or government is providing more subsidies, or whatever is happening. So what's going to happen now? What do you think would happen? What do you think is going to happen to your aggregate demand and your short-run aggregate supply? Your aggregate demand is actually going to, what's going to happen to your aggregate demand, guys? What's going to happen to your aggregate demand? It's a demand pull inflation. The inflation is caused by higher demand. So what's going to happen to your aggregate demand? Are you guys there? What's going to happen? It's going to increase. It's going to shift. It's going to shift to the right. There you go. You're exactly right. It's going to shift to the right. It's going to shift to the right. What's going to happen to the what's going to happen to the supply? What do you think is going to go to the supply? The assumed supply remains unchanged. The demand increases. So what happens? The prices go up. So what do you think now your unemployment rate? Is the unemployment rate is low or high? What do you think at this point in time is going to happen to your unemployment rate? Is the unemployment rate is going to be more, or if your unemployment rate is going to be high now? You are beyond full employment GDP. So what would happen to your unemployment rate now? Is the unemployment rate is more or less at this point in time? It is less. If it is less, what will happen to the wages? What will happen to the wages if the unemployment is less? Your wages go up. If the wages go up, what will happen to your supply? Your supply curve is going to go down, go to the left, and that's where the prices go up. This is demand pull inflation. So in simple terms, you need to understand demand pull inflation is caused by increase in aggregate demand, but supply side inflation, which is cost push inflation, is caused by inflation caused by lower supply. Because logically thinking about it, if you think the raw material prices are going up, what do you think suppliers will do? Suppliers will increase the prices because they want to pass on the raw material prices in price increases to you. They don't want to take that hit. They don't want their margins to fall. So that's what they do. But when the demand is more and people know that the demand is more, so the sellers are not going to sell it at a lower price. They're going to sell you at a higher price. So that's the demand pull inflation. So now we are moving on to slide 126. We are pretty much done with the rate of inflation, how to calculate them, and different type of inflation, demand pull and cost push. Now we're going to talk about non-accelerating inflation rate of unemployment. This is a very interesting topic. For you to understand, you need to understand certain things. If it makes sense to you, then I'm more confident, you understand more economics now. Now, the thing is this. If you have high unemployment rate, what do you think will happen to inflation? Think about it. You have high unemployment rate. Many people are unemployed. What do you think about their purchasing power? And you think about it, if people are unemployed, their purchasing power is low. Will they create more demand or will they create less demand? What do you think they create? They create less demand. If they create less demand, what do you think is going to happen to the prices? What do you think is going to happen to the prices? Prices drop because we're talking about demand. If people are not buying, what happens to the demand? People are not buying, isn't it? Because when there is more unemployment, people don't have purchasing power, they don't buy. If they don't buy, how can people in companies increase the prices? No, they can't. Right? The prices go down. The prices go down. But think about it. If you have a low unemployment rate, okay, what do you think about the inflation? Inflation will be more or less. If you have a low unemployment rate, your inflation is going to be more. Why do you think your inflation is going to be more? If you have low unemployment, you have more wages, people have more purchasing power. So that would mean you are going to create more demand. So you should understand that. So there is which one do you think is good? Do you want to reduce your unemployment rate or increase your unemployment rate? Nobody is speaking. Don't think about anything else and get complicated. Just answer straightforward. What do you want to do in a country? You want to reduce unemployment rate or you want to increase unemployment rate? You want to reduce unemployment rate. One of the side effects of that is what? What is the side effect of reducing your unemployment? Inflation. So this is exactly what I want you to understand. The side effect of reducing unemployment rate is more inflation because more people get salaries now, they spend money, prices of goods and services go up, and this is what we call demand pull inflation. Okay, now this is a very interesting topic. Non-accelerating inflation rate of unemployment. This will tell you what is the unemployment rate which will not increase wage push inflation. That is what it is. So Nehru is the lowest unemployment rate that will not induce wage push inflation, also called natural rate of inflation. So which means that what they are trying to tell you is, let's say 2% is your non-accelerating inflation rate of unemployment. So this is what 2%. So which means at 2% unemployment, you do not have, you do not have inflation, wage push inflation. But if you reduce your inflation below 2%, let's say your unemployment is 1%, then there is like more demand for labor. There's going to be wage push inflation because there's going to be an upward pressure on the salaries, more wages. So that's going to create a cost push inflation. So any country needs to know what is the unemployment rate they can comfortably maintain, which is good for the economy. In the meantime, they do not cause any wage push inflation. That is what non-accelerating inflation rate of unemployment. It is likely varies over time across countries, not necessarily same as full employment. It is not full employment or zero cyclical unemployment because wage pressure may be in different economic segments. We are not talking about full employment. We are not talking about zero cyclical unemployment. We are talking about the rate of unemployment which will not cause cost push inflation. Now tell me something, just to check your understanding. If you are reducing the unemployment below your non-accelerating inflation rate of unemployment, what will happen to your inflation? This is all what I want you to answer. If you are reducing the unemployment below 2%, assuming 2% is your non-accelerating inflation rate of unemployment, it varies from country to country. What's going to happen to your inflation? Your inflation is going to go up. You're exactly right. Your inflation is going to go up because you are increasing your you're reducing your unemployment rate, meaning more and more people are employed. Now there is more demand for labor. There is an upward pressure on wages. That's going to increase cost push inflation, and that can also create a demand pull inflation. That's the other thing, because when more people are employed, you have more money, you spend more money, the demand goes up. You also have cost pull inflation. That's it. Cost push inflation. So the demand pull inflation can also come. Right, now we are done with that. So now we are moving on to three type of indicators: leading indicators, coincident indicators, and lagging indicators. So you should be in an exam context. What you should be prepared is to know them. They might ask you, they might give you a couple of indicators and ask you to identify which one is a leading indicator, which one is a lagging indicator, which one is a coincident indicator. So you need to first understand what these indicators mean. These indicators, what they do, they indicate something. They indicate maybe a recession is already the recession is there, or the recession is on the way, or recession is already almost over. So they're going to give you some indication about whether your economy is overheating. Are you in the peak, or are you in the recession? Where are you? So these indicators provide you information to assess the state of your economy. That's what these indicators. So what is the meaning of leading indicators? These are the turning points in the economy which precede business cycles and business cycle peaks and troughs. So peaks means the highest possible point an economy can reach, and your economy is overheated. What's going to happen immediately after a peak? Can you think about it? What's going to happen if you are in the peak? What's going to happen? What do you think is going to happen if you are in the peak in an economy? What's going to be the next stage? Think about it. It's a recession, because if you are in the peak, the next point is a recession. Your economy is going to fall. If you are in the recession, the next point is a recovery. So you should understand. So that's what it is. So these are basically what you need to understand are factors precede business cycle peaks and troughs. Meaning, they are going to tell you whether there is a recession, or whether there is a peak, or whether there is a boom, or whether there is a recovery. Even before those events happen, they highlight you some risks and benefits. That's leading indicators. They lead you into the future. What is lagging indicators? Useless to look at them. Why? Because these are turning points. They tend to follow business cycle peaks and troughs. It's like a post-mortem, isn't it? They're going to tell you what happened in your economy. Good example is unemployment rate. Is unemployment rate, is it a leading indicator or a lagging indicator? Is it telling you that there is a problem on the way, or already the problem is there for you? Or is it a result of a problem? Unemployment is a result of a past problem, isn't it? So which means this is a lagging indicator. This is going to tell you, okay, something happened. Okay. What is coincident indicators? They coincide with the business cycle peaks and troughs, which means they tend to happen at the same time when you have a business cycle peak or a trough. That's what we mean by coincident indicators. So you should know, I think you should have a look at them and understand what they are. When you keep looking at them, you would understand what they are. Let's look at what some of these leading indicators are. Weekly hours, manufacturing data. If you look at United States or Europe or in the UK, they publish these statistics. Some of the statistics are weekly, some of the statistics are monthly, some of the statistics are actually quarterly. So you can look at these statistics. Weekly hours, how many hours you work. Manufacturers, new orders, how many new orders have been placed. They give you some information about future. New orders index, stock prices, because stock prices, in an efficient market, they don't reflect the past, they also reflect the future. So stock prices, some stock prices are going up. What do you think? Okay, maybe there is some news hidden behind that. It's not that the company made a good profit and the stock price is going up. Stock market is efficient. If you think stock market is efficient, they are going to react even before a news is announced into the market. New unemployment insurance claims, manufacturers' new orders, building permits, leading credit index, consumer expectations. So consumer expectations that you gather through surveys, what consumers think is going to happen. Those factors are actually going to provide information about future. So that's what we call leading indicators. And we are moving into coincident indicators. They are going to happen at the same time during a business cycle peak or a recession. Employees on non-farm payrolls, industrial production. What is the industrial production taking place now at the moment? Personal income, less transfer payments, manufacturing and trade sales. Orders are leading indicators, but current sales is dropping or sales is increasing. Whatever that happens, that is a coincident indicator. You should be able to understand the differences, isn't it? Moving on to lagging indicators. So these are basically indicators that tell you your economy is, just past a peak or a trough. Duration of unemployment, how long you are unemployed. Prime rate, inventory sales ratio is changing. Manufacturing and trade data, commercial and industrial loans, how much loans have been granted to these sectors, consumer price index, this is the inflation, manufacturing labor cost per unit of input, consumer credit and personal income ratio. These are called lagging indicators that's going to tell you that you have just completed a business cycle peak or trough, because look at this, turning points in this trend to follow business cycle peaks and troughs. So you should be able to understand these. Okay, there's a list of questions. Now, what do you think these things are? What do you think the first one? Can you tell me which type of indicator is this? Payroll employment is increasing. What do you think it is? Payroll employment is increasing. Is it a leading indicator or coincident indicator or a lagging indicator? What it is? What do you think, guys, it is? Payroll employment is increasing. Is it a leading, lagging, coincident? What do you think it is? What do you think it is? First one is a coincident. Look at this. Employees on non-farm payrolls, payroll employment is increasing, meaning that is coincident. Employees of non-farm payrolls. So you have employees who are not doing farming but anything other than agriculture. That's what that is. So that's basically a coincident indicators. Okay, the next one. What do you think about manufacturers' new orders are decreasing? What do you think about it? You should be able to tell me this. This is a leading indicator. Why is this a leading indicator? This is going to tell you something about the future, isn't it? This is going to tell you something about the future. So that's a leading indicator. Average prime rate is increasing. What do you think it is? Average prime rate is increasing. Then did you see that? Prime rate. What do you think prime rate is? What type of inflation, what type of indicator is that? Prime rate is actually a lagging indicator. Okay, now the next one is more interesting. This is going to, okay, you're going to tell me this. Your yield curve is flattening. Normally, how does your yield curve looks like? This is interesting, which I have discussed with you before in fixed income. I think your yield curve, we are talking about the interest rates on one axis and the years of maturity on the other axis, is usually upward sloping, isn't it? Why do you think it is upward sloping? Because higher the maturity, higher the risk, higher the interest rates. But if you have a downward sloping yield curve or a flat yield curve, what does that mean? Remember, we spoke about this before. This is what it is. If you have a different yield curve than what you are seeing normally as an upward sloping yield curve, it happens every time before an economy experiences what? What do you think it is? A recession. That's exactly right. Every time before a country experiencing recession, you see their yield curve is either flattened or they are downward sloping. What does that mean? Which interest rates are more than which interest rates? If you say downward sloping yield curve means which interest rates are more? Do you see short-term rates are more, long-term rates are more? What is true when you are talking about a downward sloping or a flat yield curve? Short-term rates are more. Usually, what is more? Long-term rates are more than the short-term because of the risk element. The risk is more in the long term. But when it works on the other side, then we say recession is on the way. Now, this should give you an idea. Okay, what do you think this is? Is this a leading indicator or is it a lagging indicator? What do you think it is? Is it going to tell something about the future? What do you think it is? It is a leading indicator because it's going to tell you recession is not there already, but recession is on the way. It's not happening when there is recession. It is happening. It would happen when recession is on the way. It is a symptom. It is a symptom. If it is a symptom, if it is a sign, then it is typically a leading indicator, right? But if it's actually you caught the infection already, something happening to you, it's coincident. Okay. Now the infection is gone now, but you still have the side effects of the medicine, side effects of the inflation. You don't no more have inflation. You're not a carrier anymore, but you still have pains and headaches and dizziness and all sort of stuff. So that's what lagging indicators, if you want to understand that way. So if you think about yield curve flattening, that's telling you about something that's going to happen. So that's what we said is the leading indicator. Inventory sales ratio is increasing. That would actually mean that it is a lagging indicator. It is always better. What you do is you go through these terms. I think this pretty much covers most of them. You know, if the questions are going to come in, that's going to come in deep from this area. So derivation of from this, and questions on this particular topic is very popular. Which one is leading, which one is a lagging indicator? So just go through them. So that should definitely help you. Now, what do you think is this economy is? Your inventory to sales ratio is increasing. What does that mean? Inventory to sales ratio is inventory increasing. So means what is happening? Yeah, are you building up more inventory? Or are you building up less inventory? Inventory to sales ratio is increasing, meaning inventory divided by sales is increasing, means you have more inventories. You have more inventory, so it is increasing. There is inventory build up. Yield curve is flattening. So what do you think is going to happen in this economy? New orders are falling. What do you think is going to happen? Your new orders are falling. What do you think is going to happen? There is going to be a recession. So if recession is going to happen, where are you now? What is the state of the business cycle that this economy is in? No, just before recession, where are you? You're in the peak. You're in the peak. You're going to come down. Look at this. I'm going to show you that. When we spoke about business cycles at the beginning of this study sessions, you look at that. This is what we were talking about. You see, you've got a peak When you're in the peak, and the next thing that happens is a recession. So you're at the peak, the economy is overheated. That should drop now. So that's what it is. So that's what you should understand. So it's sometimes there is a thin line between a leading indicator and a coincident indicator and a lagging indicator. So it is very important that you read this couple of slides very carefully and remember them. In the exam, you might not really have time to think about whether this is futuristic or this is a post-mortem or which is a current event. So I think this particular thing is best if you could remember them, which one fits in well. Right, so that's about the end of that study session, and we are going into a new study session, which is perhaps the most important one in the entire economy for the reasons that I mentioned earlier, in terms of exam context as well as practically if you want to understand how a country is doing, if you follow the central bank's policies and the government policies, that's going to give you more understanding and insight about what's happening. Now, let's get going here. Slide 133, we are talking about monetary policy. So you should understand what monetary policy is all about. Who implements the monetary policy? First question to you. We're going to talk about monetary policy and the fiscal policy today. That's going to be a very important and interesting discussion. So you should tell me, who implements monetary policy? Who implements monetary policy? Central bank. So remember that monetary policy is implemented by the central bank. Right. The next question is, there is another policy which we call them fiscal policy or budgetary policy. That policy is implemented by the government. That's exactly right. So two things to remember. These are the two policies a country uses to control inflation, to improve, reduce unemployment rate, to increase GDP, to help an economy out from a recession. So these are the policies which countries use to achieve their macroeconomic objectives. What those objectives could be: GDP growth, which is what we call economic growth, could be one objective. Low unemployment could be an objective, but if you have a low unemployment rate, what's going to happen? We said there is a side effects of high GDP and low unemployment. If your GDP is more and if your unemployment is low, what's going to happen? What's going to happen if your GDP is more and unemployment is low? What is the side effect of that? We discussed about it. What's going to happen if you have low unemployment and higher GDP growth? Your economy is heating up, and what do you think is going to happen to the inflation? What do you think your inflation is going to look like? Your inflation is going to go up. So the government needs to control that. So the government needs to control your inflation, achieve GDP growth. Increase in GDP growth, how do you call it? How do you call it? Where GDP continues to increase. What is the name for that? This is what is economic growth. How your economy is growing. If your economy is continues to decline for 3 consecutive quarters, how do you call that? How do you call that? We call them recession. That's exactly right. So objective of the government is what? The government wants to increase the GDP growth to achieve economic growth. They want to reduce unemployment rate. They want to, what else they should do? They should reduce inflation, increase GDP growth, reduce unemployment rate. What else? There are other problems, like if there are poverty or inequality of income between rich and poor, the government should intervene. How can they intervene and control that? If rich and the gap between rich and poor is more and more, what can government do about it? Can you think about it? Practically, what happens? How can you solve this problem? If there is a big disparity between rich and poor in a society, what can government do about it? We're not talking about monetary policies, we yet to talk about it, but giving you an overall perspective. So you're exactly right. You use tax rich. Take that money. What do you do with that money? What can you do? If you want to reduce the income inequality, you tax the rich, take the money, pay that as a subsidy or transfer payment or unemployment benefits to poor people. So that way, you're trying to reduce the income gap in your society. So these are kind of objectives: economic growth, reduce unemployment, increase control your inflation, and reduce poverty levels. Try to bring in a try to strike a balance between income inequality, income gaps, and things like that. Right. So now, in order to achieve these macroeconomic objectives, some of the objectives are conflicting between each other. Can you give me two objectives which conflict? You should understand. We're going to talk about more interesting stuff. This is probably the cream on economics, which everybody wants to be on top of, which everybody wants to understand. What's happening into your fiscal policy and monetary policy, what your central bank and the government is trying to do. Right? Can you tell me some conflicts between your macroeconomic objectives? What objectives do you think are conflicting between each other? Some objectives, they do conflict between each other. What those objectives are? Unemployment and inflation, you're right. Unemployment rate, lower the unemployment rate, lower the lower the unemployment rate, higher the GDP, and higher the inflation. So if your unemployment rate is lower, GDP growth is more, that is good, but on the other hand, you have a problem. The problem is higher inflation. So you want to bring in price stability. Price stability is like stable prices. How do you bring it? So that is why countries implement two types of policies. One is monetary policy, central bank of a country, which is the head of all the banks, right? They implement something called monetary policy to control the money supply in a country. Through controlling money supply, they help the country to achieve the macroeconomic objectives: increase output, reduce inflation, reduce unemployment rate, reduce poverty, etc. That is what monetary policy is aiming to do. So how are they going to do it? Central bank is going to control the money supply. They think money supply is everything. If the money supply is more, there is more money everywhere. It's flooded. Money is flooded. If you want credit, you go and ask money, they will lavishly lend you. They don't even look at your credit conduct, or they don't even look at your credit worth. They just lavishly lend money to everybody. If that happens, what do you think is going to happen to the prices? What do you think is going to happen to the prices, guys? If you think that money supply is more, if there is more money everywhere, what's going to happen to the prices of goods and services? It's going to go up. Why? Everybody is going to buy things, isn't it? It's going to go up. So what the central bank needs to do now, if the money supply is more, what do you think the central bank is going to do? They are going to reduce the money supply or increase the money supply further? What you should do? If you think your money supply is more, inflation is high, you want to reduce the money supply. So if you reduce the money supply, what can you do? Can you control your inflation? If you reduce the money supply, can you control your inflation? Yes or no? What do you think about it? Can you reduce the money supply and control your inflation? Yes. Now the next question is, how do you control inflation? I'm going to just tell you only one strategy which central bank uses, but we're going to talk about a little more on the strategies in the slides to come. But I'm going to tell you the central bank is going to decide the interest rates in the economy. So they are going to now increase the interest rate. Okay, look, now you should be able to tell me what's going to happen. Central bank is increasing the interest rate. What will you do as an individual? What will you do? Will you invest money with the bank, or will you spend money? What will you do if the interest rates are increased? Would you save more money, or would you spend more money? You invest in the bank. You save in the bank. Savings are going to go up. Your spending is going to reduce. If the spending reduces, what will happen to your What is going to happen to your inflation? What is going to happen to your inflation? If the interest rates are increased, the inflation is going to go down because people are not buying. And think about businesses. If the interest rates go up, do you think businesses will borrow more money or borrow less money? What do you think the businesses will do? Businesses will borrow less money, then less money supply, they will not spend again, prices come down, inflation will be under control. So this is what we call a contractionary monetary policy. If your inflation is too high, your unemployment rate is too low, inflation is too high, you are happy about unemployment, but you're not happy about inflation. How can you reduce inflation? Should you increase interest rates or decrease interest rates? Can you answer this question? If the inflation is very high, what you should do now? Increase interest rates or reduce interest rates? What do you think you should be doing? Should you increase? You should increase interest rates. If you increase interest rates, people will not borrow and spend. People will save money, less spending, less money supply, less demand, less inflation. So you should use a contractionary policy if you think your inflation is high. But what do you think? You think your inflation is very low and your GDP is low, your unemployment is very high. What do you think the central bank should do now? Unemployment is very high, people are not working, they don't have money, and banks are not lending money, and people are not investing. So, what do you think is central bank should do now to support the economy? What they should be doing? They should be reducing interest rates or increasing interest rates. If the economy is struggling to grow, unemployment is more, money supply is less, and GDP is low, inflation is very low, maybe you have a risk of deflation, prices are going down, what you should be doing? You should reduce interest rates. What happens when you reduce interest rates? As an individual, what will you do? Will you spend more money now? Will you spend more money or less money? If the interest rate is reduced, you spend more. When you spend more, you don't save money. You spend on real estate, you spend on your essential, you spend on your luxury goods. Prices go up, production increases, GDP grow. Unemployment will reduce, GDP will grow. Why unemployment will reduce? If you buy more goods and services, companies will have more profit, they will have more business, they will hire more people, unemployment will come down. What will businesses do? If you reduce the borrowing rates, if central bank is reducing the borrowing rates, what do you think the businesses are going to do now? Are they going to borrow more money or are they going to borrow less money? They're going to borrow more money. If they're going to borrow more money, then they're going to spend more money. Money supply is going to go up, inflation will go up, but economy will grow, unemployment will come down. This is what we call expansionary monetary policies. Now I'm going to ask you a question. What the Fed has been doing now, if you look at it around the globe, what the Fed has been doing over the last 1.5 years or so, with COVID-19 kicking in and people not spending money, there is a reduction in money supply, high unemployment rates around the globe. Almost all the central banks in the world, what did they do? What did they do to their interest rates, guys? What did they do to their interest rates? Did they reduce the interest rates or did they increase the interest rates? What happened? What do you think has been happening globally for the interest rates? The interest rates have been falling. Central banks have been reducing interest rates around the globe, including that of Central Bank of the United States called Federal Reserve, Fed. It's been reducing interest rates significantly. Now, what do you think is the interest rate in the United States? Between 0 and 0.25%. That's the interest rate. And European interest rates, if you understand, is negative interest rates, meaning that if you keep money in your bank, in the bank, technically speaking, if you keep money in the bank, they charge you. They don't want money. They keep money in the bank. They want you to spend. They want you to steal that. They want you to spend. So meaning if you borrow money, you're going to get money from banks. Why do you think all this negative interest rates, regardless of whether they have really helped the economy or not, the one thing that you can say is that the negative interest rates, the reason for implementing negative interest rates is to encourage spending. All of them are expansionary policies, isn't it? Right. The next question before we move forward. When do you think countries implement contractionary policies? When do you think countries implement contractionary policies? When, under which situation countries' central bank implement contractionary monetary policy? Under which circumstances? It's very simple to answer. These questions are not difficult. Think about it. When do you think central banks introduce contractionary monetary policy, increasing the rates? Your inflation is more. Exactly, you are right. Your economy is overheating. Your GDP is high, good. Unemployment rates are low, good, but we are not happy because the inflation is out of control. You need to increase the rates, control inflation, stop spending money. Banks stop lending money to people so that you control inflation. But when do you implement expansionary? So which strategy, okay, summarize, which strategy you would use when you have a recession? Which strategy would you use when you have recession? Will you use expansionary or contractionary? Which strategy would you use if you have recession? You use expansionary. Expansionary means you want to reduce interest rates, increase money supply, help businesses. You want inflation now because in a recession, the fear is deflation. If you think about it, everywhere, what people are worrying about now is deflation. Why deflation? Because people are not spending money. People are not spending money. Deflation is a risk. Everyone will be happy about deflation. But if deflation is there, that signals something really wrong. The economy doesn't have demand, which is bad. So then the central bank reduces interest rates. Hope you understand what this means. I'm moving on to the next policy. We'll come back to fiscal policy. It's not over. We talk about a little bit more in detail, but I'm now going to talk about this is the policy implemented by the government. We call it budgetary policy or fiscal policy. It's the same. It can be interchangeably used. You say government budget or government fiscal policies, budgetary policies, same thing. Here, what the government is going to do is that government is going to use their revenue and spending to help the economy, depending on which stage they are. When do you think central bank is going to reduce taxes and increase spending? They are going to increase spending on transfer payments, pay subsidies, reduce taxes. Why? What do you think? Is your economy struggling or is your economy is doing well? When do you think the central bank, when do you think the governments do all this? They reduce taxes and they increase spending. When do you think they do it? When your economy is struggling, you are exactly right. When your economy is struggling, they help you lower the taxes. This is what you call deficit budgets, isn't it? The government is going to have deficits, yes or no? Why deficit? Your expenditure of the government is going to be more than the tax revenue that they have, or the other type of revenues that they have. The revenue is not enough. They implement a deficit budget. The deficit budget is important. Why? Because they want to help companies to do well. They want people to spend money. They want economy to move ahead. So they borrow money from local markets and international markets to implement a deficit budget to help companies to do well. This is what expansionary fiscal policy. Increase government spending, which is G in your aggregate demand, C plus I plus G plus X minus M. The G is the government spending. Increase the spending, reduce taxes, create a deficit budget, increase aggregate demand. But when do you think you implement a contractionary fiscal policy? Can you think about it? When do you think you increase taxes, you reduce spending, and you decrease the budget deficit? If you have a budget deficit, you want to decrease it by increasing your taxes, decreasing your subsidies. When? When do you think you implement a contractionary policy? By increasing taxes and decreasing expenditure. Why? Is your economy is struggling? What is the problem? You are at your economy is peak. You are exactly right. Your economy is like overheated. You think there is high inflation. What do you need to do? You want to reduce your inflation. So what will you do now? You want people to spend less. You will reduce tax, increase taxes, reduce spending, reduce money, reduce the overall aggregate demand, and that is going to reduce the inflation. But what will happen to economic growth if I ask you in a contractionary policy? What do you think will happen to the economic growth and the unemployment rate? What do you think is going to happen to the unemployment rate in a contractionary policy? What do you think is going to happen to your unemployment rate in a contractionary policy? You have a contractionary policy, means you're reducing spending and you're increasing the taxes. So what do you think is going to happen to unemployment rate will increase, but it's okay because we want unemployment to go up. Why? Because people are spending too much money. There is money everywhere. We want to reduce aggregate demand. We want to cool down the economy. We want to reduce aggregate demand because we want to control inflation. That is what the economy, the government is doing now. Final question before we move forward. I think I pretty much covered most of the stuff in fiscal and monetary policy. The remaining slide should go much faster. Final question from me on this slide. What do you think about in a recession, which monetary policy to use? Sorry, which fiscal policy to use? Which fiscal policy to use during a recession? Expansionary. What will you do in an expansionary fiscal policy? What will you do? What are your weapons? In central bank monetary policy, your weapon is what? Your interest rates. But in the fiscal policy, what are your weapons? Increase spending, increase government spending, reduce taxes, increase budget deficits. You borrow and spend. That's what you do. In a higher inflation situation, what strategy would you follow? What strategy would you follow? In a higher, you would reduce spending. What else will you do? Increase taxes. That's what you do. Okay. A central bank is reducing interest rates. Is it a fiscal policy or a monetary policy? Central bank is reducing interest rates. Is it a fiscal policy or a monetary policy? Monetary policy. Is it an expansionary policy or a contractionary policy? Is it an expansionary policy or contractionary policy? Central bank reducing rates. Expansionary policy because they want people to spend money, they want businesses to invest money. You're exactly correct, and that's about what we need to know at this point in time. So now I'm going to move on. Okay, we introduced about monetary policy, fiscal policy. We not just introduced, we went a little bit more into it, discussed about more details of policies. And before that, now we are going into some lighter material now. What are the functions of money? What can money do? There are three major functions of money. Medium of exchange, you buy goods and services, you pay money. This replaced historical barter economy. You know what barter economy? You give something, you give rights, and you get something else in return. So it's like you exchange goods and services, right? It's called barter economy, and that replaced money. So that you pay money and then buy goods and services. That's what functions, the primary function of money, medium of exchange. And now the question is, but unfortunately, this is economics, which we have been studying for so many years. But now the functions of money has been put into questions. It's with the introduction of digital currencies, and before that, the introduction of credit cards, debit cards, tap and go and things like that, things like that would mean that money probably is going to go, isn't it? In the long run, people don't accept it. Even now, in so many places, they don't accept cash, isn't it? You cannot give them cash. You have to use a credit card or a debit card. And then we are also talking about digital currencies. So things like that, would question the ability of money to act as a medium of exchange in the future. Right? But that's a primary purpose of having money. Unit of accounts, it measures, if you want to measure how much is a phone or how much is something, how do you measure? You measure them in terms of units of money. Okay, it's $100 or $200. That's what you measure. Store of value, meaning if you want to save for your future, for your kids, for yourself, for your retirement planning, what are you saving? You are saving money. So, functions of money. Store of value, unit of account, medium of exchange. Right. Money supply. What is the meaning of money supply? Money supply is the amount of money that is available in a society. Higher the money supply, the GDP growth will be better. But what is the problem if your money supply is higher? Can you think about it? Can you think about it? If you're talking about higher the money supply, here you got the point. Higher inflation. What should the central bank do? What should the central bank do if the money supply is more? If the money supply is more, what should the central bank? Increase interest rates. So you've got the point. Implement a contractionary monetary policy. Contractionary means slow down the economy. Expansionary means expand the economy, increase inflation. The same applicable in fiscal policy. In expansionary means reduce taxes, increase spending. Contractionary means decrease spending, increase taxes. It's pretty much the same thing. Right, now we're talking about money supply. There are different definitions for money supply. There is M0 money supply, which is not there in the slide, but I can tell you M0 is just the notes and coins in the circulation. It is the currency notes and the coins in circulation. The total amount of money people have in their hands, not in the bank account, is what M0 money supply. Right. M1 is called narrow money supply, and US and Eurozone, that includes your cash in hand, checkable deposit, which is the money in your current account, which you can pay by using your checks. Traveler's checks, these are all comes in your narrow money supply. But when you say broad money supply, M2 in US, M3 is called M3 in Eurozone, that includes M1 plus, M1 will be one of M2 for sure. So you will have M1 plus the money in your savings account, the time deposits, which is less than $100,000, and then money market funds, mutual funds. The short-term investments will also come into your broad money supply, M2, M3. The movement of these money supplies will actually tell you the inflation, what's going to happen to your inflation in your country. If your narrow money supply is increasing, what do you think is going to happen? Is the inflation is going to go up or what? What do you think about it? The narrow money supply is increasing. People have more money in hand. It's going to increase. Even if your broad money supply is increasing, you can easily withdraw the money in these accounts, because we are talking about money market savings accounts. So overall, increase in M1 and M2 money supply is going to increase money supply, and that is going to cause trouble to the economy. So that's the definitions of money supply. We are actually now moving on to credit creation of banks. I'm going to explain to you how a bank is going to create money. So we're going to talk about creating money. So banks usually create money, meaning if you give them $100, they create money with that. That's what we call credit creation. That is why it's a major source of, we say that's a major source of inflation in countries. All right, so I'll stop with that for the prayer breaks, and now it's 2:55 p.m. and I'm going to see you at 3:10 p.m. to go forward with the remaining slides. Thank you. Okay, welcome back. So let's get going with the remaining portion on monetary and fiscal policy. So we are here at this point in time. We're actually going to talk about, how central banks create money. So what happens is that when you deposit money in a bank, the bank is going to create more money than what you actually deposit in the bank. So that's what we mean by credit creation. Now, what is the business of bank? Is bank takes deposits from customers and lend it to businesses as loans. So it's banks, they don't lend their own money. Obviously, they have their equity capital, but most of the time what banks do is they take money from customers' deposits and lend it to the business. So when customers deposit money in the bank, banks actually going to create multiples of that money as a credit to businesses, and that is what we call credit creation. So now we are actually going to see how that happens. So let me explain you how the credit creation happens. For example, if you say, if you're talking about the customer deposits $1,000 in a bank, and most of the times in most of the countries, central banks have a mandatory reserve ratio, which means, let's say 10% of the money cannot be lent to customers. So what the banks needs to do, 10% of this money needs to be set aside with the central banks as a reserve, so that that money cannot be used for lending purposes as a protection. In case if the customer wants to withdraw the money, part of it, there is some protection over there. Let's say here 10% of the money is actually retained. So, which means how much money that can be lent? Can you guys answer in this case? How much money can the central bank lend out to another customer? If the reserve ratio is 10% and if the deposit amount is $1,000, how much do you think the central bank can lend? Are you guys there? How much do you think the central bank is going to lend? The central bank is actually going to lend 900. Why 900? Because 10% of 1000 is 100. That will not be lent. So how much will be lent is 100 is going to be lent. That's exactly right. So now, 100 will not be lent. 900 will be lent. So when you say 900 will be lent, 900 will be lent or deposited in the account of the borrower. Let's say A is the customer who deposited the money. There is a guy called X, is the money guy who's borrowing. So the bank will deposit 900 in the account of X. Do you think the X is going to withdraw all the money from the bank immediately? Practically, what do you think? Do you think X will withdraw all the money from the bank immediately or no? When the bank is lending you money, they don't give you money in your hand. They deposit in the bank account of yours, your current account or your savings account. That's where they deposit the money. You don't withdraw the money immediately unless if you need them, but generally most people, they don't, including companies. So because you need money over a period of time, not just one time. So what happens is this 900 will be in the savings account or whatever account you have, and you have now X. X in his balance sheet, in his account has 900. On that, 10% will be withheld as a reserve. 810, the 10% of that is going to be 90. So $810 will be, uh, given to somebody else, let's say Y, as a loan. So that 810 will be lent. So how much will be lent to Y? 810, meaning it's not given to his hands, it's given to him on his current account or savings account is deposited. Then what the banks will do, then the bank will have that Y 810, you have 10% of that, which is 81. How much is the balance? The balance is going to be 810 minus 81 is going to be 729. So 729 will be lent to Z. 729. It will not be given to its hands. Again, this is what credit creation using $1,000. Usually, what we do is we calculate your, we calculate your credit creation. There is a formula to calculate that. I'm going to take you through that. It's called credit multiplier. That's going to tell you how many times you can create credit using your money that you have. So which means, you can probably create 10 times of credit, create 10 times of credit from $1,000. So if you have $1,000, if your credit multiplier it 10 times, you can actually create $10,000 in people's bank accounts. So this is what we call credit creation. Higher the credit creation, higher the money supply, higher the inflation. So if a country wants, a central bank wants to banks to lend more and more money, what they can also do is they can reduce the reserve ratio. If the reserve ratio is reduced, more money will be lent to people, so money supply will increase. So this is another thing that they can do. Okay, now I'm going to ask you one more question. If the central bank is increasing the reserve ratio, is this a monetary policy or a fiscal policy? First of all, you need to answer this question. If a central bank is increasing reserve ratio, which banks needs to keep without lending, it's monetary because it's done by the central bank. The next question is, if the bank is increasing this interest rate, reserve rate, is it a contractionary monetary policy or an expansionary monetary policy? What do you think about it? Is it a contractionary or an expansionary monetary policy? The bank is increasing the reserve ratio. It is contractionary. Why? When this increases, what will happen to bank's ability to lend? What do you think is going to happen to the bank's ability to lend? The bank's ability to lend is actually going to drop because they need to keep more money with the central bank. Their ability to lend is going to drop. Money supply will come down. So that is what we need to understand. So now we're going to go back and talk about how to create money. Fractional reserve banking system. A bank is required to hold a fraction of its deposits in reserves. This fraction is the required reserve ratio. Bank receives $1,000 in new reserves, can loan out 750 with RR of 25%. So 750 in loans deposited, and then you got 563 in new loans. It continues to happen. 563 times 75%, and 423 keeps on happening. This is what credit creation is. So now maximum deposit multiplier, how we can calculate this is you divide 1 by your reserve ratio. Suppose your reserve ratio is 25%. 1 divided by 25% is 4 times. So if you have $1,000 in your country, multiply that by 4. 4,000 can be created. With 1,000 deposits, 4,000 money can be lent. That is what credit creation is. So how you calculate it? 1 divided by your reserve ratio. In other words, if you have 1,000, divide 1,000 by 0.25, you get 4,000. So that's the straight way of getting, instead of doing 1 by 0.25. You can straight away take 1,000 divided by 0.25, you will get $4,000. So 1,000 can become 4,000. Multiplicative effect. That's what we call credit expansion multiplier. Increase in reserve requirement will decrease the money supply. Decrease in reserve requirement will increase the money supply because you have more money that can be lent to people. Demand for money. So remember we said supply for money is the money that is available in the system, and demand for money is the money that you have in your hand. The amount of money that you have in your hand, not in your bank account, not in your investments, not in your real estate investment, but how much money you want to have in your hand. It depends on 3 things. Transactionary demand for money, precautionary demand for money, speculative demand for money. The demand for money can come into 3 forms. Number one is transactionary demand, which would mean that how much money you have in your hand to spend on your day-to-day expenditure. If the GDP is more, your income is more, which means you have more money in your hand to buy goods and services. So that's your transactionary demand for money. Precautionary demand for money is the money that you have to meet contingencies. If you think there's something unexpected that can happen, how much cushion that you have in your wallets in order to meet them. Again, it increases with GDP, increases with needs. I mean, if you are doing a risky job or if you are kind of living a risky lifestyle, then probably you need to keep more precautionary demand for money. That's something important to remember. So that's precautionary demand for money. And moving down, speculative demand for money is basically the money that you keep in your hand now so that you can take future investment opportunities. If the interest rates are low now and you are expecting the interest rates to go up in future, then you keep more money in your hand, because when the interest rates go up, you invest. But if the interest rates are high now, it's expected to go down in the future. You invest now, so your demand for money comes down. Why it comes down? Because demand for money is all about the amount of money that you keep in hand. So what is the relationship between interest rates and speculative demand for money? If the interest rates are currently higher and it's expected to go down, then you invest more now, demand for money comes down. But if you think the interest rates are currently low, it's going to go up. Your demand for money for speculative purposes is going to go up because you are keeping money in your hand now to take advantage of higher interest rates in the future. So this is what demand for money, the amount of money that you keep in your hand for transaction purposes, precautionary purposes, and speculation purposes to invest in the future. Supply of money is decided by the central bank. How much money they want to print, money printing, because central bank, they print money. So at the end of the day, how much money in a society or an economy is decided by the central bank. But whether it is in the hands of people or it is in banks, that depends on people's decisions. But at the end of the day, the overall amount of money is printed by the central bank. So this is what we're talking about, a money market. Money market is a short-term market. So if you look at a short-term in a money market, so you're actually talking about demand and supply. Right, so you say you interest rates on one hand and the real money, the amount of money that you have is on the other hand. You see the money supply is limited. Why do you think the money supply is limited, guys? Why do you think we keep the money supply constant here? Any reasons why we keep the money supply constant? Can you answer the questions? Why? Why is that money supply constant? Who decides? Because it's constant in the sense that money supply is the amount of money available in a particular economy. So if you think about money supply as such, the supply is limited to the amount of money published by the central bank. So central bank knows how much money that they published, because that is what money supply is, isn't it? So demand for money is downward sloping. Why? If the interest rates are more, will you invest more money or less money? If the interest rates are more, what do you think will happen to demand for money? If the interest rates are more, can you see here? If the interest rates are more, what do you think is the demand for money? This is the money for demand. So demand for money comes down. Why? What would you do if the interest rates are more? What are you going to do now? You're going to take advantage of that. And what are you going to do? What are you going to do if the interest rates are more? What will you do immediately? Will you keep money in your hand, or will you deposit money in the bank? What will you do? Will you invest your money, or will you not invest your money or keep it in your hand? What will you do if the interest rate is more? What are you going to do? If you're interested, you invest now. So what will happen to demand for money? Demand for money means the amount of money that you keep in your hand, that is demand for money. So demand for money, what do you think is going to happen at the high interest rates? So demand for money is going to go down because you're going to invest it. Okay. When the interest rates go down, what do? Will you keep the money in your hand or will you keep the money in the bank? What you do if the interest rates go down, what would you do? Would you keep money in your hand? You keep money in your hand. So that's why this curve is downward sloping, and this is where your interest rate currently. Now what happens? When the interest rate is more, okay, if the interest rate is increased to this point, what happens to your demand for money? Can you think about it? If the interest rate is here, this is your equilibrium interest rate. If the interest rates go up, what happens to your demand for money, guys? Demand for money dropped from here to here, it reduced. It reduced. It reduced. It shifted to the left, isn't it? You're right. So what happens here? So then what happens now? What the central bank needs to do is they are going to purchase treasury bills so that they are going to inject additional money into there is excess supply of money. So they are actually going to purchase securities in order to bring the money supply and demand back into equilibrium. I'm going to explain that in detail in one of the other slides. So I'm just going to explain to you briefly here, and we are going to talk about it in detail later. Now, see what's happening when the interest rate is lower. What happens to demand for money? Demand for money is more. Why? People don't want to invest because anyway they're not getting any interest. Why would you invest? It's to keep the money in your hand. So your demand for money at lower interest rates, when the interest rate is lower, the demand for money is more because you want to keep more money in your hand. At that point in time, what you need to do, you need to sell securities to bring the money supply back into equilibrium. So you see what's happening. There's excess demand for money. Demand is more. You sell the securities, so people buy the securities and invest the money. It backs to equilibrium. And if you think the money supply is more, but demand for money is less at high interest rates, you buy the securities, and that way, that's what you do in order to bring the money supply into equilibrium. I'm going to explain that in detail in a little while. Okay, look at this. This is the Fishery fact. This is going to tell you how you decide nominal interest rates. The interest rates that you charge, there is two types of things. One is riskless nominal interest rate, and the other one is nominal interest rate, which is including the risk. So if you are investing in a risk-free security, think about it. If you are investing your money into a risk-free securities, can you give me an example of a risk-free security, guys? What is the most popular risk-free security that we speak about? What do you think is the most popular risk-free securities that we speak about? We speak about treasury bills. And we speak about treasury bills, so that's what we do. So you have a real risk-free return, and then if you want to think about it, you have expected inflation, and you add the inflation into the real risk-free rates, which is the minimum return you want to keep your investment. That is what you need. That's what in your mind. Okay, I need 2% because I am investing my money, and I want to compensate myself for the inflation. If not, my value of money value will come down. So if the inflation is 2% and you want 2% return, so how much return that you need on a risk-free basis? How much money return you would need on a risk-free basis? Can you think about it? How much is the interest rate that you need on a risk-free basis? You need 2% for as a real risk-free return, and then you need 2% to compensate for your inflation. So overall, what is the interest rate that you need to compensate for you to invest your money because it's your money, and then to also compensate for the inflation? So how much will be the total interest rate? 4%. 2 plus 2 is equal to 4. Now, if you're investing your money in a bank, not in a treasury bill, there is some form of risk there. So you need an additional risk premium for that. And that's why we say your nominal interest rate, risky one, will include real riskless rates, real without inflation, and then you're adding for inflation, then you're adding a risk premium, and that becomes your overall interest rate. Right, now we are talking about the roles of central banks. What does central banks do? Okay, look at that. Central banks issues currency. They are the monetary board. They issue notes and coins in a country. And they are also a banker's bank of bankers bank. It's a bank of the bank. Why do we call it a bankers bank? Because they lend money to banks in times of need. They support banks in times of need. We sometimes call it lender of last resort. If the banks they don't have any other means, and so many banks around the globe are being bailed out by central banks, because otherwise there's going to be a systemic collapse, which is going to lead to severe economic consequences. So central banks bail out, they lend money to banks, they support banks, so that's why we call they are a lender of last resort. They are a bank of the government because they lend money to banks and they lend money to governments as well. They regulate banking and payment system. They are the regulatory body. The Federal Reserve is a regulatory body for all the banks in the United States. European Central Bank is a regulator for European banks. They impose restrictions on lending. They introduce capital adequacy rules, like how much capital banks needs to hold. Also, the regulations are set by the banks. Lender of last resort, we spoke about it. They hold gold and foreign currency reserves for emergency purposes. They hold these reserves and they build up. They conduct monetary policy. Through monetary policies, what are the things that they do? Can you tell me whatever that you know of now? We spoke about two things. They decide two things in a monetary policy. Using what? Yeah, they do control inflation. That's exactly right. How do they control inflation? What are the instruments? Interest rate. There you go. What are the other thing that they can use to increase or decrease money supply? How can they increase or decrease money supply? See, money supply is what they control. But how they control money supply is my question. So, in putting things into perspective, central bank needs to control money supply to achieve a particular rate of inflation. If they want to reduce inflation, they want to reduce money supply. If they want to increase inflation, they want to increase money supply. That's what they need to do. But how do they do it? Using what instruments? They use interest rates. Number one, increase or decrease interest rates. Anything else can you do? Anything else? What about the reserve ratio? Remember we spoke about reserve ratio. What do you need to do with the reserve ratio? Do you need to increase the reserve ratio or decrease the reserve ratio if you want to increase the money supply? If you want to increase the money supply, what do you need to do for the statutory reserve ratio? You need to decrease so that more money can be lent. So that's another one. And then the third thing is they can buy and sell securities. Remember I spoke to you a little while ago. I'm going to explain you in a forthcoming slides. Right, so that's monetary policy for you. Objectives of the central bank. As I spoke to you earlier, central banks have macroeconomic objectives. They want to increase GDP, reduce inflation, full employment. They want to promote economic growth. They want to also make sure the exchange rate between their country and the other countries are stable, so that there is no unwanted volatility of your exchange rates. So how they do all this? They do all this by controlling the money supply. You got to understand fiscal policy, what the government does. Government tries to control the aggregate demand and control and achieve their macroeconomic objectives. But what does central bank do? Central bank, do they try to control aggregate demand? What do they look at? They try to control the money supply and thereby achieve their objectives. So now most of the time they have a target inflation rate. In the United States, they say they want inflation to be 2 to 3%. You know, they want unemployment rate to be 4%. So that's their target. You know, with the COVID, the unemployment rate went to double digits, more than 10% in the United States. It's gradually coming down now. So their objective is to maintain an unemployment rate of less than 4% and inflation rate of 2 to 3%. They don't want inflation to be below this, then it becomes deflation. They want to maintain good growth but low inflation. So that's their target. Keep long-term interest rates moderate. You don't have to want to have too much interest rate, too little interest rates as well. Expected and unexpected inflation. So this is very interesting. What is the expected inflation means? The amount of money that the amount of inflation that you expect. Next year, you expect the inflation to be 5%. If you keep expected inflation, if it increases the cost of holding money. Why? Because if you hold more money in your hand, if the inflation is increasing, if there is inflation, what do you think is going to happen to the value of money in terms of purchasing power? What do you think is going to happen to the purchasing power of money when the inflation is more? Can you think about it? Decrease. So that's the problem. So it increases the cost of holding money, and it increasing the cost of frequently changing advertised prices. If the inflation is more, you need to keep changing your selling prices of your goods and services, which is a problem. But you should understand, unexpected inflation, let's say suddenly there is some supply shortages, there is some issue with your agricultural system in the country, there's a shortage of vegetables. What happens to vegetable prices? Can you think about it? What will happen to vegetable prices in such case? The vegetable prices increases. So that's what happens. So any unexpected your inflation, when you're talking about additional cost of unexpected inflation, you have more inflation there. So if you have more inflation than what you anticipated, what you expected, what would happen is the wealth is shifted from lenders to borrowers. You should understand this. That it is a very beautiful explanation of why during an unexpected inflation, the wealth is shifted from lenders to borrowers. I'm going to give you an example here. Let's say I'm lending you money. I'm lending you money, and I'm lending you money. Let's say I'm lending you money at 5% because I know the inflation is 5%. Inflation is 5%. That's why I'm lending you money at 5%. Because if I lend you money 1,000, you give me 1,000 back after a year, I'm a loser because the purchasing power of 1,000 is now less because of inflation. So I'm a loser. So that's why I'm charging you 5% interest. So how much are you going to pay me after a year? How much are you going to pay me after a year? Can you answer me? 5% is the interest rate. I'm giving you $1,000. How much are you going to pay me next year together with the interest and the principal? How much will you pay me? If 5% is your inflation and I'm charging you interest rate of 5 because I don't want anything else from you, I'm just charging you only the inflation as the interest rate from you. So how much will you pay me if I lend you 1,000 today? You're going to pay me 1,050. All right, you're going to pay me 1,050. If the actual inflation is 5%, I'm okay. You know, I can go and buy the same amount of goods and services using this money now. But suppose your inflation is 7% now. What does that mean? Your expected inflation is 5, but actual inflation is more than that. Who is impacted? I am impacted or you are impacted? You are a borrower, I am a lender. What do you think about it? Who is impacted here? Lender is impacted or the borrower is impacted? The lender is impacted. Why? Because the lender is getting less compensation for their money. So whose purchasing power is coming down? Can I use this 1,050 and buy the same goods and services that I could have used to buy 1,000 a year ago. No, I can't. I need how much I need now. I need 1,070 to do that. Do I have 1,070? No. Who benefited? Who benefited on this arrangement, guys? Is the lender or the borrower? The borrower benefited. So that's where the problem is. So that's why I say unexpected inflation. Shift the wealth from lenders to borrowers. Less reliable supply-demand information and price changes. If inflation is not predictable, if there is unexpected inflation, it's bad. Companies make wrong pricing decisions, they make wrong production decision. Business cycles will be less stable, there'll be more uncertainty. Remember, that's the key point. There'll be more uncertainty in the market when there is unexpected inflation. But inflation can be predicted easily. The only problem is your cost of holding the money is more, otherwise everything else can be easily anticipated. Okay, now this is the most important slide. Now we are actually going to do what can you do with the policy rate. The policy rate is the rate of the central bank, which is the rate at which the central bank charges other banks for borrowing money from the central bank. So in that point of view, what do you think what will happen to the money supply when the policy rate is increased? Think about it. When the policy rate is increased, what will happen to the money supply? Can you think about it? What will happen to the money supply when the policy rate is increased? Central bank is increasing the policy rate, the interest rate they charge to banks when the bank wants to borrow from the central bank. Is this going to reduce the money supply or is it going to increase the money supply? Interest rates are going up. We should be able to answer immediately. It's going to reduce. Why now? You think banks are going to borrow from central bank for lending purposes? No, they're not going to borrow from the central bank. So they can't lend money to customers, which means money supply will come down. Look at it, increasing the policy rate. Discourage banks from borrowing reserves. Thus, banks reduce their lending. You don't have money. Because if you have enough money, central bank is lending you, take that money and lend it to your customers, but you don't now. Decreasing the policy rate tends to increase the amount of lending and money supply. Right? The rates decrease. What will banks do? They will borrow from who? If the interest rates, policy rates are decreased, what would the banks do? They would borrow from the central banks. And after borrowing from the central banks, what would they do? They would lend the money to their customers at low cost of capital. Everybody will borrow money, money supply will increase. In the United States, the policy rate is called federal funds rate. You don't have to necessarily remember these terms because CFA exam is international, although the CFA Institute is based in headquartered in the United States. So you don't have to necessarily know them, but just for your knowledge, Fed funds rate is the policy rate of US central bank. Currently, the Fed fund rate stands at 0 to 0.025%, meaning that they are at historical lows as part of what policy? Expansionary policy or contractionary policy? What do you think the central bank is doing now? Are they doing an expansionary policy or a contractionary policy by reducing the interest rates to historical lows? Expansionary. What is their objective? What are they trying to do? What are they trying to do? Are they trying to increase the money supply or are they trying to decrease the money supply? Increase the money supply to boost the economy, GDP. They want to increase inflation. That's what they are trying to do. So now I'm going to talk about open market operations and required reservations. You need to give me a minute. Just a minute, please. Sorry about the delay. So what we're going to do is we are actually going to talk about monetary policy tools. Already you know about two tools. One is the interest rates or the policy rates, or you can talk about required reserve ratio. We already spoke about them. And this is also one of the things what some central banks did during COVID-19 first wave last year. What happened was required reserve ratios of central bank, they reduced for banks so that they encourage banks to lend more money. Because when they lend more money, there's no money in the system, there's more money in the system, more money supply, people spend more money. That is the understanding of reducing the required reserve rate. But if the central bank wants banks to reduce lending, what do you think they should be doing? What do you think they should be doing if they want to reduce the required reserve ratio? What do you think the central bank should be doing? What do you think the central bank should do if they want to reduce lending to people? What do they need to do for the required reserve ratio? If they want to reduce lending, banks lending to people, what do they need to do on the required reserve ratio? They need to increase the required reserve ratio so they lend less money. Okay, now the last thing I'm going to tell you is the open market operations. What central banks do is, this is what I told you, I'm going to explain to you later. So I'm explaining you now. When central bank, they do sell treasury bills on behalf of the government, because treasury bills are issued by the government when they want to borrow money or they want to inject money into the economy. So what happens is, during open market operations, what happens is that very often what happens is, during open market operations in a recession, what the central bank needs to do they need to increase the money supply or they want to decrease the money supply? What do you think they should do? Should they increase the money supply or decrease the money supply? They should increase the money supply to support the market. What they do is they go and purchase the treasury bills already with the banks. Already banks have purchased treasury bills from the government and they hold it. The central bank is going to buy them back. So if the central bank is buying the bonds back, this is what we call bond buyback program. Security buyback program. So when they buy, who is going to give money to who? Central bank is buying treasury bills, means they have to give the money to the banks. So banks are going to have a large amount of money with them now. So what would happen? The banks will have more money, they will lend more money, there will be more money supply, people will spend money, and inflation will go up, GDP will go up, unemployment will come down. So in a recession, central bank should buy the bonds, bond buyback program. And if you go back and think about, during every recession, what central banks have been doing? Central banks have been reducing interest rates. Central banks have been reducing the reserve rate. Central banks have been buying bonds in the market. But what do you think the central bank should do when the economy is overheated? They want to reduce inflation. What do you think they should do with regard to open market operation? Should they buy the securities or should they sell the securities? What do you think they should do in a overheated economy? Economy is doing well, but the inflation is very high. They want to reduce inflation. They want to sell. If they're selling it, who's buying it? Banks are buying it. If the banks are buying it, where the money is going to go? Is the money is going to be with the bank or is the money is going to be with the central bank? Where the money is going to be? The banks are going to buy the securities, give the money to the central bank. Central bank is going to tightly hold them, not to lend it to anybody. So what happens? Money supply comes down, inflation will be under check. This is what they do. So now, summary, all what we discussed. If you want to do an expansionary monetary policy in a recession, what are the three things you do? This is all comes down to this finally. If you want to implement an expansionary monetary policy, what are the three things that you need to do? You can think about it. Okay, that's a great answer. The first answer is reduce interest rate. Fabulous. That is number one. What else will you do? What are the other tools you have to increase the money supply? Reduce reserve rate. Another fantastic answer. That's correct. Number three, purchase securities. There you go. Those three put together is what you call expansionary monetary policy. Increase money supply. It will promote economic growth because people will spend money, reduce unemployment. What is the side effect of expansionary monetary policy? What do you think is the side effect of expansionary monetary policy? What do you think is the side effect of expansionary monetary policies? You need to think about it. It reduces unemployment, which is good. So, but what is the side effect, which is essentially a bad thing, isn't it? Okay, there you go. You are exactly right. When money supply increases, inflation will come up. So they need to again do something to control that. Okay, so that's fantastic. In other words, if you want to do a contractionary monetary policy, increase interest rates, increase reserve rates, sell securities in the open market. So required reserve ratio seldom used. The most important things that central banks do is interest rates and open market operations, buying and selling securities. They don't really want to adjust reserve ratio very often, but if you see some banks, they really did this during COVID because they wanted to use all the tools that they have as part of their monetary policy. Super. So monetary policy translation, what happens in an expansionary monetary policy? Market interest rates fall, less incentive to save. So you borrow money, you spend money. That's what you need. You borrow money and you also spend money. Asset prices increase, wealth effect consumption increases. That's what happens. Expectations for economic growth increases because everybody thinks with lower interest rates, things are going to be rosy, people are going to borrow, people are going to spend a lot of money. So that's what expansionary monetary policy effect. And then what happens here? Domestic currency depreciates. Why do you think your domestic currency depreciates if you have an expansionary policy? You know, what happens to your inflation? Can you think about it? In an expansionary policy, you have lower interest rates, isn't it? When you have lower interest rates, people don't invest into your country. Foreign investments will come down. So what happens? Your exchange rate depreciates because there is more demand for foreign currencies where the interest rates are more, and in your country there is less demand. So your currency depreciates. When the currency depreciates, it's good for exports because export prices come down, imports prices go up, and imports reduce. Therefore, your overall trade balance improves. So overall, an expansionary monetary policy will increase aggregate demand, increase real GDP, employment, also inflation. Inflation will go up. You should know that this is what I told you is a side effect of an expansionary monetary policy. But now you should also understand something more. Basically, when you say central bank's characteristics, you should understand that when central bank wants to do its job professionally, you need to make sure that the central bank needs to be independent, meaning that they should be free from bias. Yeah, in the sense that they should make independent decisions. They should not be under undue influence from this government. This is what has been happening previously with the Trump government in the United States. Always Trump had been influencing on central bank decisions, firing central bank chairmen and threatening them to fire or forcing them to reduce interest rates. They did not give that freedom to central bank to design their own policy. So if a central bank wants to be credible, they need to be free from undue political influence. Because if the government wants to do something, what policy should they do? What policy do you think they should follow? What policy you think? There you go. You are exactly right. You should be following fiscal policy without coming and influencing on central bank decisions. Central bank decisions needs to be independent. Central bank should be credible, meaning that they should follow stated intentions and policies. They should not say something and do something. That's bad. Transparent. They should publish economic data, inflation data. They should become more transparent. Independence, credibility, transparency. So if you have these type of characteristics, a central bank that is independent, credible, and transparent can influence expectations. Policy changes are anticipated and easier to implement. So that's what these characteristics of central banks. Right, now what we're going to do is we're actually going to talk about monetary policy effects on the economy, right? So when you say monetary policy effects, you need to understand when a central bank buys securities, think about it, what happens. Okay, think about it. If the central bank is buying securities, is it going to have an expansionary effect or contractionary effect? Can you think about it? If the central bank is buying securities, is it going to have an expansionary effect or contractionary effects? Expansionary effect. Banks will have more money. Interbank lending rates decrease because there is more money. So interbank means the rate at which one bank lending money to another. That is interbank lending rates reduce. Short-term loan, long-term lending rates for corporates reduce. People will borrow more money. Businesses will borrow more money. They will increase investment. Consumers will increase their consumption because they don't want to deposit money with the banks because interest rates are anywhere low. Rather spend. So you spend more money and domestic currency depreciates, exports increase. All of this will support aggregate demand. So what we are explaining is how buying securities will help to improve GDP by improving aggregate demand. Moving further down, central banks usually have interest rate targeting. They usually say that they want to keep interest rates at a target level. They say we want to target interest rates between 1 to 3% or something like that. But you should understand increased money supply growth when interest rates are above the target or below the target. So increased money supply growth when the interest rates are above the targets, and in the meantime, decrease money supply growth when interest rates are below the target. So we know how this works. When there is when there is a recession in the country, you decrease interest rates, and on the other hand, when there is a peak and higher inflation, you increase interest rates to control the money supply. So that's what interest rates targeting. Inflation targeting. So what happens? Target band for inflation rate. You keep inflation at 1 to 3%. Let's say like United States, they have an inflation rate target of 2 to 3, I think. So what you need to do if the inflation is low? Can you answer this question? You think the inflation is low? What do you need to do to the money supply? Can you answer this question? If the inflation is low, what do you need to do to the money supply? You want to increase the money supply. How would you increase the money supply? What would you do? What would you do to increase the money supply? Reduce interest rate. There you go. You are right. Increase money supply growth when inflation is below the target band. Decrease money supply growth when inflation is above the target band. Target inflation band is greater than 0 to prevent deflation, because usually most countries, central banks have a target inflation of above 0, because below 0, if the inflation is below 0, how do you call it? It's deflation. You don't want deflation, isn't it? Okay. Exchange rate targeting, and some central banks, they always want to target a specific exchange rate. You say, okay, we want our currency to trade with the dollar in the range of 1.5 to 2 for let's say your currency is X, so your central bank says we want to have a currency X to trade against dollar between 1.5 to 1.6. So that's what they want to target. So they're doing a targeting of exchange rate. So what they need to do now, if they see that your exchange rate is basically above the target, meaning your local currency is appreciating, then what you need to do, you need to sell the local currency, buy the foreign currency, buy dollars, sell local currency, depreciate the currency towards your target band. But what happens? What do you think happens if your currency is depreciating more? Below your target band, you want 1.5 to 1.6, but it goes above 1.6, means your currency is depreciating more. Which currency you should buy more? You should buy your currency, sell dollars. This is what central banks do to manage currencies. If your currency is depreciating, what they do is they buy more local currencies, sell dollars in the market. When they sell dollars, the supply of dollar increases, value of dollar goes down. So this is why the demand supply understanding is very important even for you to understand exchange rates. When do you think the exchange rate appreciates? Exchange rate appreciates when you have more foreign currency coming into your country, more demand for your local currency. But why do you think, many countries, including countries, large economies like India, etc., where the currency continues to depreciate against dollars? Can you think about it? Why do you think the currency continues to drop? Because they are all oil dependent economies. They depend on the oil for other countries. That's what I meant. They import oil. So when they import oil, what happens? There's a demand for dollar and a supply of rupees. So what happens is that the rupee depreciates and dollar appreciates. This is that. So what central banks do is they buy and sell dollar to manage the currency within a target band. If you want to support your local currency, you should sell dollars. If you want to reduce the value of your local currency, you should buy dollars. Okay. Central banks doesn't react to domestic economic conditions, but they rather want to manage the exchange rate. This is what's called exchange rate management, to manage the exchange rate. But the result of a successful exchange rate targeting is that your inflation in the domestic market will be similar to the inflation in a developed country. So that is the ideal objective of why exchange rate targeting happens, because if you are managing your local interest rates in line with local exchange rates with dollars in a pretty much stable range, you are having a stable inflation similar to that of a developed country. Right, this is an interesting theory, very often tested. You've got to pay attention now here. The neutral interest rate, so this is something very important. Neutral interest rate equals to trend growth rate of real GDP plus target inflation rate. This is what we're talking about. Now, what is your real GDP growth? First of all, you should understand the neutral rate of interest rate that central bank wants to use as a policy rate is the neutral rate. They want to take the trend growth of real GDP. Is real GDP, is it with inflation or without inflation? What do you think about it? What do you think about it? If your real GDP, is it including inflation or without inflation? Is it with inflation or without inflation, your real GDP? We call it real GDP. Is it including inflation or without inflation? Are you guys there? We're talking about real GDP growth. Is the real GDP including or excluding inflation? Without inflation. It's excluding inflation. You are exactly right. This is the best measure of economic activities. and you add the target inflation rate. This is the inflation rate that you want to have. So your long-term trend in your GDP without inflation plus the inflation rate should be your target interest rate. That is a neutral interest rate. Don't forget that. Because why do you charge interest if you are a lender, you are lending into a guy? Why do you charge interest from them? Because you don't want to lose money because there is inflation. So interest rate is a compensation for inflation. Think about that. So you have a real GDP growth, you have a target inflation that gives you a neutral interest rate. Think about this. This is fabulous. If you understand this, that is great. If your actual policy rate, you are charging interest rates more than the neutral rate. So what policy are you charging? Are you using contractionary or expansionary? Easy to remember because you are charging more interest rates in reality, which is your policy rate, than what you should be charging based on neutral rate. So that is a contractionary policy because you are charging more interest. On the other hand, if you are charging less interest in your policy rate compared to your neutral rate, right, that's going to be expansionary policy. That's going to be expansionary fiscal policy. Sorry, expansionary monetary policy. You're charging less interest rate compared to neutral rate. So that is a neutral interest rate. Here, contractionary and expansionary policy is easy to remember. If your policy rate is more, then it is contractionary. If your policy rate is less than the neutral rate, that is expansionary monetary policy. Okay, the last thing that we are going to talk about on monetary policy is that limitations of monetary policy. What are the limitations? Long-term rates may move oppositely to short-term rates because inflation expectations change. We cannot expect that long-term interest rates and short-term interest rates behave in the same manner. When central bank is using policy tools, increasing interest rates, they want all the interest rates to go up or all the interest rates to come down. But what if it doesn't really happen? The long-term interest rates and short-term interest rates, they behave differently. Then you cannot implement monetary policy. That is number one. Number two, if the monetary tightening is extreme, what do you think is going to happen? If you are tightening the monetary policy means, what are you doing? Are you following expansionary policy or contractionary policy? What do you think about it, guys? If you are tightening your monetary policy, what are you following? If you are tightening your monetary policy, what are you following? You are following a contractionary policy. Expectations of recession may make long-term bonds more attractive, decreasing long-term rates. So you should understand if the monetary, this is very interesting, isn't it? If the central bank is tightening the monetary policy, what they should be doing to the interest rates? What do you think they are doing to the interest rate? Are they reducing the interest rates or increasing the interest rates? What are they going to do? In a monetary policy tightening, what they should be doing? Should they be cutting the interest rates or increasing the interest rates? Can you think about it? They should be increasing the interest rates. If they increase the interest rates, in the long run, would you agree that there might be a recession? Would you agree that in the long run, there will be a recession because they increase the interest rates? There is going to be a recession in the long run. So that is going to make long-term bonds attractive, which means the long-term bond, people are going to invest in bonds in the long term. So bond price is going to go up, bond yield come down in the long term. So long-term bonds will be attractive. So there is some conflict. Short-term rates are going to be more, long-term rates are going to be lower. Central bank will not be properly able to implement their monetary policy. If the demand for money is very elastic, people will hold currency even as the money supply increases, referred to as a liquidity trap. So why do you think if the money supply is increasing, the reason why Why do you think central bank reduces interest rates? Do they want you to spend more money, or what do they expect you to do? What do you think they expect you to do? Why do you think central bank reduces interest rate? What they want you to, they want you to, yes, you are exactly right, but they want you to, they increase the money supply because they want you to spend more. Yeah, they want to increase the money supply because they want you to spend more. But what if you don't do that? What if people are more worried about the future and they don't do that? Think about, what happened in the lockdown around the globe. All the central banks, what did they do? Remember, we discussed about it. Why did they do, all the central banks around the globe during recession? They reduced rates. But did you think people were confident enough to borrow money and buy a vehicle, borrow money, buy a real estate, spend money? Now, do you think people were willing to do that? People were not willing to do that because they didn't want that. They wanted to know when the lockdown will be over, or when the infections will stop, when the corona will go away. So those were the questions. So people were still not willing to spend despite increases in the money supply, despite ultra low interest rates. Still, even if somebody borrows, lend you money at 0%, you are not confident enough to borrow because you don't think how the future looks like. The future looks very bleak. So that's why sometimes these policies don't work, and this is called liquidity trap, meaning central bank increases the money supply, but you still tightly hold on to your money, you don't want to spend. Okay, this is last two weaknesses are also interesting. Let's say central bank wants banks to lend more money. They reduce interest rates. They ask banks to lend money. But this is exactly happening in COVID-19. Again, a classic example. Or this is what happens even during a financial crisis. Central banks will reduce interest rates. What do they expect banks to do? Do they expect banks to lend more money, or they expect banks to less lend money? They want to lend more. They want to ask banks to lend more money, isn't it? They want banks to lend more money because, let's say, what's happening is in the market, there is recession, so central bank wants banks to lend more money to the customers. But the problem is, what happens in a recession, the risk of default? What happens to the probability of default in a recession? That increases or decreases? It increases. So, if you are a bank, will you be lending money in a recession to all the companies? Will you be lending money to all the businesses in a recession? No, you will be more careful, you will be more choosy. But what central banks want you to do? Why are they reducing interest rate? They want you to lend more because they want to increase money supply, they want economy to grow. But are you doing it? Your risk department, your risk policies don't permit you to do that. In such cases, your monetary policy fails to work. Even if interest rates are lower, if banks are not lending, do you think money supply will increase or no? If the banks are not lending, it's not going to increase. Then you think the monetary policy is going to be effective? Is your monetary policy going to be effective? Then no, it's not going to be effective. And then again, you need to understand there is a limit on which central banks can reduce interest rates. There is always a 0%, and most central banks don't want to reduce interest rates below zero. Unlike the European Central Bank, they have their interest rates below 0% in negative interest rates. But in all the other economies, like what United States, they don't want to bring the interest rates down to below 0%. So there is a ceiling. Interest rates cannot be below zero. That's again another limitation on central bank. If your interest rate is already zero, what can central bank do? They should do something else. They cannot use monetary policy anymore. Okay, fiscal policy now, as we already discussed about it, there are, what do you think expansionary fiscal policy is? You should be able to answer this question as well. What do you think expansionary fiscal policy is? What do you do in an expansionary fiscal policy? What do you do to your taxes? fiscal policy is implemented by the government, they are going to use taxes, they are going to use government spending and deficits as a tools to operate the economy. They reduce taxes. What do they do to the spending? Spending on subsidies, spending on sons of payments, unemployment benefits, and things like that. They're going to spend more, reduce taxes. What would happen to budget deficit? What would happen to budget deficits? Budget deficit is going to go up or come down. Budget deficits increase. What type of policy is this? Is this an expansionary policy or contractionary policy? This is a expansionary policy. The beautiful thing that happened during this recent recession caused by the pandemic is that central banks and governments did a coordinated effort. What do you mean by that coordinated effort? Is that the central banks kept the interest rates lower. They were buying securities in the open market. They did so many initiatives, and on the other hand, governments were reducing taxes. They were giving unemployment benefits to people. They were paying just people money to spend, just to improve the economy. If you really look at the economics news, if you see, Australia has been paying very recently $50 or $100 a person to spend on weekend. So just to boost spending. So that is what they were doing. So central bank one side, on the fiscal side, government was trying to do. So there was a coordinated effort. If one policy is expansionary, other policy is contractionary, it's hard to do something. So, but if both policies are expansionary, that would help. Right, so moving contractionary fiscal policy, what do you think in a contractionary fiscal policy? What happens there? What happens in a contractionary fiscal policy? What do you think? What do you need to do to the taxes? What do you need to do to the taxes? Increase taxes, reduce spending, reduce the budget deficits, and what do you think is going to happen to the aggregate demand? Aggregate demand is going to come down, GDP is going to come down, but what is going to happen to the inflation? Inflation is going to be lower because people are not going to spend money. So understand fiscal policy. Now there are three types of theories, or I would call them Keynesian economists, monetarists, automatic stabilizers. What they mean is that they are different school of thought, different theories based on Keynesian, monetarists, and automatic stabilizers. Keynesian means these are set of guys, right, who believe in monetary policy. They think monetary policy is the only way to help an economy by controlling the money supply. So they think fiscal policies, sorry, I'm going to mistake. Keynesian believe in fiscal policy. Monetarists believe in monetary policy, right? So Keynesians, what they think is, they think the fiscal policy or a discretionary fiscal policy is the right way of controlling an economy or stabilizing an economy. When aggregate demand is low, implement an expansionary fiscal policy. When the aggregate demand is high, implement a contractionary fiscal policy to manage the economy. So Keynesian thinks the right way to manage an economy is through fiscal policy by controlling the aggregate demand. But on the other hand, monetarist thinks that fiscal policy cannot do much in the economy. They think central bank has the ultimate power to use the monetary policy, control money supply, control inflation, and do wonders with monetary policy. So what you need to understand is that Keynesian economists focus on fiscal policy and monetarists focus on monetary policy. So monetarists believe that the Keynesians' budgetary policies are just temporary. Let's understand what Keynesians say. They say believe discretionary fiscal policy can stabilize the economy. increase aggregate demand, combat recession, and decrease aggregate demand to combat inflation. Now, people are always talking about it. When do you do expansionary fiscal policy? When there is recession. When do you do contractionary fiscal policy? When there is inflation, isn't it? So, but monetarists believe no, that doesn't work because we want central bank to intervene. Just the government alone is not enough. They believe such effects are temporary and appropriate monetary policy will dampen economic cycles. So the monetary policy is very important. Automatic stabilizers, meaning this theory says there is no need of policy interventions. There's no need of central bank intervening in the monetary policy or government influencing with the fiscal policy. If you just let your economy work in its own manner, the problems will get fixed. That is automatic stabilizers. They say during a recession, naturally, there will be more transfer payments, more subsidies. That's going to happen. So when that's going to happen during a recession, there's going to be more transfer payments, less taxes. So that's going to naturally help an economy to recover from a recession. Then what happens during a peak? What happens? They cut spending, they cut transfer payments, they increase taxes. Then what's going to happen? Under such scenario, what's going to happen is that what's going to happen is that during that time, a peak will become a recession will become naturally a peak with taxes and transfer payments. Let me explain that once again. Normally what happens in a recession, you increase your transfer payments, reduce taxes, so people spend more money, you will come out of a recession easily and economy will stabilize. On the other hand, when you have a boom, naturally your taxes will go up and transfer payments will reduce, your economy will go slow down. From a peak, it slows down, goes into a recession. So that's what we mean automatic stabilizers. By just using taxes and transfer payments, you can automatically stabilize an economy instead of influencing the economy a lot more. So that's what automatic stabilizers is on the fiscal policy. Now, what is the objective of fiscal policy? You want to control your aggregate demand and economic growth. You want to redistribute wealth. I think I spoke about it. What can you do? What do you need to do if you want to redistribute wealth? What do you think you should do to redistribute wealth? Can you guys talk about it? How can you redistribute wealth in an economy? What can the government do if you're talking about fiscal policy? Redistribute wealth, meaning what? You need to take money from rich people, give it to the poor people. That is what redistributing the wealth. How will you redistribute the wealth? Increase taxes on the rich. Yeah, increase taxes on the rich and increase transfer payment to the poor. So you're taking money from the rich and you're giving it to the poor. So that's going to redistribute the wealth from who to who? From poor to rich to the poor, isn't it? How do you increase aggregate demand? You reduce taxes, increase subsidies, create a deficit budget. Affect the allocation of resources to different sectors of the economy. How can you, if you want to improve healthcare, allocate more budget allocation, money allocation to the healthcare sector? If you want to increase education, allocate more money to the education ministry. Depends on what you want to do. Allocate more funding, spend more money into those respective sectors so that you can improve those sectors. If you feel transportation in your country is bad, spend more money on transportation as part of your budgetary policy, so that can boost spending on transportation, improve the quality of your transportation. So these are the objectives of fiscal policy tools. What can you do in fiscal policy? What are your tools? Spending and taxes, isn't it? Spending, transfer payments, subsidies, You give subsidies to redistribute wealth. Who do you give transfer payments? To the rich or to the poor? Who do you give transfer payments? To the rich or to the poor? You give the transfer payments to the poor to redistribute the wealth. Current spending, current spending, the two types of spending. Current spending by the government in the fiscal policy is the day-to-day spending on paying to their staff salaries in the government sector and purchase of goods and services. That's current spending. You increase the current spending, that would also increase aggregate demand. You can also increase the capital spending. This is the infrastructure spending on transportation and airports and things like that. So that is again capital spending. Current spending would boost the aggregate demand. Okay, I'm going to ask you a question. What do you think would boost the economic growth in the long term? Current spending or capital spending? Which one do you think is going to increase the economic growth of a country in the long run? There you go. Capital spending. Why? Because if you spend on infrastructure in the long term, you're going to have employment opportunities. The GDP is going to grow in the long run. Economy is going to flourish. Now, the revenue side, this is the spending side. Revenue side, direct taxes are taxes on the income of people and income on companies' earnings. Indirect taxes are taxes on goods and services. So it's charged through prices. A good example is a VAT, value-added tax, or an excise duty on tobacco products. So now direct taxes and indirect taxes are usually lowered during a recession as part of expansionary fiscal policy, and direct taxes and indirect taxes are increased during high inflation to combat inflation through a contractionary fiscal policy. So that's the end of fiscal policy tools, revenue and spending. We are in slide 16, and that's the end of today's session. It's already 4:35 local time, so I'm going to stop it now. Enjoy iftar, and I'm going to see you on Wednesday. Thank you and have a good evening.